Perfect. So welcome everyone to this month's Masterclass. We try to offer these once a month, but it depends on demand and who wants to lead a class. So if anyone on the call wants to lead a future Masterclass, please feel free to contact Colin or myself. We'll pop our emails into the chat box. But today, I'm so excited to introduce Keith from Spring. He's the CEO and co-founder, and he'll be leading a conversation around diverse funding models today. So again, as we mentioned, love to have your participation and your input and engagement on this call. Colin and I will also be throwing in questions as they come up. We love to be on these calls just to participate and learn more. And Keith is a wealth of knowledge and experience. So we're so happy to have him today and have his time and investment in the community at commuters.org. The call will be about 90 minutes in total, but just depends on like participation and engagement. And so I just want to really emphasize that and welcome that on today's call. So with that, just to maximize our time together, I'm going to stop presenting and I'm going to hand the mic over to Keith. Thanks, Keith.
Amazing. You'd think after 2 years, I would know what the mute button is. So everybody, I'm super excited to enjoy the conversation that I think will come out of this. It's a topic that I'm always loving to talk about. And just to give maybe a bit of context as I dive in. So I'm a 4-time entrepreneur, 3 times in tech and in software, and then over the last 8 years plus have been running Spring Activator. Spring exists to change the world through innovation, and we work early stage, so idea on a napkin through to about 2 million in annual revenue, impact entrepreneurs and impact investors. So that means incubation, acceleration, investment readiness, capacity building, and support for impact entrepreneurs. And then on the investing side, investor training, capacity building, and deal flow intermediary work on that side. We are generally industry agnostic, but in the world of impact, right? So healthcare, education, clean tech, circular economy, progressive food and ag, impact marketplace, and e-com would be sectors that we've worked in. And then there's a number of thematic sectors that we've also worked in according to both the region that we're in as well as the partners that we're working with. We have worked in about 55 communities around the world, so spanning South and Southeast Asia, Latin America, Southeast Europe, across Canada, a few other odds and ends locations as well. But that's where the bulk of our work has been. In the companies that I've led, we've raised about 16 million in capital, and then the companies that I've advised probably raised just about $100 million now in the last little while. And so have definitely seen a lot of rounds, especially pre-seed, seed A. Sometimes pre-seed and seed might be called an angel round, depending on what city or region you're in. So sometimes the naming changes, but the stage is always the same. So for me, I'm really excited to dive in. Maybe before I get started, are there any initial questions that you have coming into this session where you're like, hey, I was really hoping to learn about, or like, I really want to like understand, X better. So I'd love to hear if you guys have anything specific that I can make sure I cover when we're going through things.
Yes, definitely. First of all, thank you for sharing your wealth of knowledge with us. But I have questions around revenue-based financing, if that's something that we could dive into. I know that, in general, some topics around that are coming up are how it's a royalty. The corollary product is a royalty. And there's just some things about that I'm still trying to understand. So if you have any experience with that, I'd love to learn more. Thank you.
Okay, it's a great question. I do have a little bit of experience in that space. So what I'll do is I'll at least give you a lead in on understanding and maybe answering some of your questions. And then maybe as a follow on, there might be some introductions that I could make either to dig deeper and or to kind of know some of the allied players who are doing really interesting work in the space. So happy to dig in on that. Yeah, cool. Thank you. Anything else?
Keith, I'd love to hear more if you have the time and space around, I think it's called SAFE, but some of the more innovative models that have less legal structure and make it more flexible for working in especially like global South areas, and any other models that you feel are more equitable and flexible for entrepreneurs coming from, you know, the global South. And any sort of like, I'm starting to learn a lot more about like Bitcoin and digital currency. I've just started this week, so my terminology might be a little bit off, but I don't know if you have any sort of concept of like, if there is a movement in social entrepreneurship and impact investing in the sort of Bitcoin cryptocurrency space. That might be totally off base, but it's just something that I've been starting to dig a little deeper into.
Yeah. So great question. Crypto is something I know just a little bit about, but I can definitely speak to some of the macro strategic trends that we're seeing, given the global work that we're doing. You asked a really important question in there, Sarah, about not only, you know, what might be relevant in the global South, but also what is equitable. And that's a very interesting conversation in any jurisdiction. And so love to have a conversation around that as well. So that's great. Any last requests before we dive in? All right, we're good. Okay, let's do it. I'm going to do a screen share and dig in. And so what I'm really going to try and do as I go through, I will have the chat window up as well, in case you guys want to type anything into chat, but obviously I encourage people to come off of mute and dive in at any point in time. But what I'm hoping to do today is I'm hoping to just give you a bit of context for both what is the current state of affairs and maybe some of the origin around that, and how that's kind of impacting financing today. And then what we'll do is we'll get into some of these more innovative models that we've been seeing emerge over the last little while. So I'm definitely excited to dig in and do that. Just again, shout out to conveners for making all of these sessions happen, including this one, and for inviting me in on that. So very much appreciated. So let's dive in on types of paperwork. The most important part when we all talk about private co-investment and early stage private co-investment is that ultimately the paperwork and the paperwork as it's selected is very often is selected based on what is the perceived levels of risk and reward. So the origin of some of the original documents like common shares, preferred shares, convertible notes payable or convertible loans, and SAFE agreements all really have been predicated on creating a template structure based on risk and reward. And then underneath, as I always like to say to entrepreneurs, actually doesn't matter what the title is on the top of the page, it's the individual terms and conditions within. So the important part is to determine how much special treatment is needed to get the deal done. And this is also critically important when we do talk about equitable opportunities for investment to happen. So the way that it is understood, generally speaking, if you walked into a room and you asked somebody like their 30-second response on the spectrum of preferential treatment based on paperwork, it does look like this. Common shares are considered to be the most equitable of the 4 traditional funding methods. And then it's a sliding scale all the way up to preferred shares, which tends to give the maximum amount of preferred treatment for the investors. So lightly put, common shares tends to be to the greatest benefit of the entrepreneur, and preferred shares tend to be to the greatest benefit of preferred shares tend to be the greatest benefit of investors. What is interesting is, as I mentioned earlier, it is the terms and conditions within. So of all the financings that I've ever seen, the worst paperwork I've ever seen was actually a common share round. And one of the better pieces of paperwork I've ever seen is actually a preferred share round for the entrepreneur, right? And so again, it's about the terms and conditions that you put in that really ultimately dictate it, but we will talk a bit more about each one in turn. And hopefully give a little bit of history. Now, one thing I will highlight to everybody is all 4 of these basically have all been generated in the fully developed world by white men who have gone to very, elite universities, right? All of these. And so there's an ingrained part of this where all of these fundamentally can be a strain. And you mentioned, Sarah, the global South earlier, but it can be a strain on many communities. So one example that I'll give everybody is in Canada, we have a reasonable sized population of Indigenous people. And so for us, sometimes known as First Nations communities as well, but currently the correct description is Indigenous. And all of these are what they would call 100% colonial. There's nothing in them that is Indigenous in any way, shape, or form. And when you want to do investments into Indigenous owned and led businesses, you really have to go through a process of decolonizing the paperwork as well as the process. And so sometimes in other communities, you will find likewise. And I actually think as we all move into 2022 and beyond, it's really critical for us to really challenge some of the structures and approaches that exist. I will hopefully, as much as I can, touch on that particular conversation as I dig in. But at this starting point, I'm going to just pause there just for a minute to see if there was any gut instinct questions on what it is I just shared, because the next step will be to dig into each one of these four in a little bit more detail, and then we'll talk about some of the newer forms of financing like revenue backed. So any initial questions or comments at this point, or are we good? All right, thank you. Landscape of paperwork. So one of the ways that I think we all want to think about this is, where are the obvious places where we can create special treatment for the investors, but we can also create parity and equity. So typically the way that we talk about it is around the pricing of the shares, are shares being given at all? Are there other things like interest rates, and what are some of the other preferred treatments? So one of the benefits of common shares is that, typically speaking, the only way that you are negotiating on preferential treatment is in the valuation of the company itself. That tends to be the major marker. So is my company worth $1 million, $2 million, $5 million, 10, 20, doesn't matter what it is per se, but the important part is to recognize that that's the major lever to pull in the common share agreements. And so the benefit is it gives the entrepreneur a lot of clarity about what they're agreeing to up front. You take away any of the advanced terms and terminology. I'm giving you a piece of the business. I'm giving you share certificates, and that's it. And so it's a great way for a lot of first-time entrepreneurs or entrepreneurs who are raising money for the first time to really understand what it is that they're getting involved in. It keeps it clean, it keeps it simple. And the crucial part is that as we're going through this process, we really need to ask ourselves the question, what is that right valuation? And so I'm going to give you guys like a simple working example. If I were to pitch a company in Vancouver, Canada, at say the seed stage, the typical round size, the expectation is probably about $1 million Canadian. If I'm pitching that round in Silicon Valley, it's at least 2 million US. So you're tacking on a 27% exchange rate difference as well for the exact same company, for the exact same round. Now, if I was pitching that same round in North Macedonia, I'm probably raising 250K euros. So the reason is because in each region and sometimes in each city, and the US is a good example of this, where in the US, the normative range for a round size in Silicon Valley is very different from Seattle, which is yet again going to be a little bit different from New York, and so on, right? And so the important part is it doesn't matter how much they're raising. If you put 100 investors in the room from 100 different locations in the world, save the most nascent economies, everybody would say to you, when you're raising a seed round, my expectation is you're giving up 20%. So notice what that does to valuation. If it's 20% in Vancouver, then the valuation on $1 million round is going to be 4 million pre, 5 million post. But in Silicon Valley, it's 10 million pre US. So the tricky part is that if you're working in a single environment, and I'm sharing this specifically because, Sarah, knowing that you're living in Guatemala City, like if it's a Guatemalan company with local investors, you don't have to worry about that. But, earlier, Sarah and Natalia, when you guys were talking about working at JP Morgan Chase and you just came from Palestine, like you could easily find investors who would invest in a company in another country. And then you have this challenge of like normative expectations on valuation and how that can help or hurt an entrepreneur. So I just wanted to highlight that. It's a nuance, but I think it's good for everybody to know. So the benefit is commons, tends to be most equitable. It is often most used in earlier stage ecosystems like the developing South, where it's really easy for people to understand because it's relatively new. And then the other one is, frankly, rock star companies in North America. Like if you're awesome, you can go to people and say, I'm going venture scale and I've got the proof. And so I'm just going to offer you common shares at the least preferential treatment at a valuation that I like. Right. So typically that's when a common share agreement is pulled out of a folder and presented. Now with convertible notes and safe agreements, they tend to sit in the middle between commons and prefs. Convertible notes actually were the first bridge. They were created, oh my goodness, at least 25 years ago. And convertible notes were designed to tackle this sticky issue of what if we don't agree on valuation? Point number one. Point number two, what if we don't agree on the level of risk and reward? And so based on that, a convertible loan was developed, and the premise being that I'm willing to allow you to defer the valuation conversation, typically for a period of 2 years. So it's a set term. In exchange, I'm getting an interest rate, which accumulates in more equity. And I'm also getting a discount on the next round. So I get two pieces of preferential treatment for sure, being the interest rate and the discount on the next round. By name, you also hear that it is a loan that sits on the paperwork, sits on the financial statements as debt. And in many cases, the investor has the right to decide if they're going to get it back as a loan or if they convert. So it's on their choice. And so typically this is a tool that actually can be used well when the company is earlier stage and it's not 100% clear on what the valuation should be, but everybody likes the company. It can also be used in a scenario where it's actually not crystal clear if the company is going to go venture scale or if it's actually just going to be a good business. And therefore maybe converting it into a loan where the investor then has like a surety on how they're going to get their money out makes sense. So that's typically when you're going to pull a convertible note out. Now, safe agreements were actually created circa 2012. And the reason it was created is because a law firm in Silicon Valley did a study. And at the time, circa 2012, there was approximately $56 billion worth of convertible note payables out in the marketplace. And so when they did this research, they put out a post and they said, well, what happens if investors start calling all of these convertible loans? And so it kind of freaked everybody out. And they proposed an idea, which then Y Combinator turned into mainstream, which is the SAFE agreement. And SAFE agreement, for those who don't know, is simple agreement for future equity. So SAFE is an acronym. And the premise behind this is it is not a loan that can be repaid in cash. That's the critical component to a SAFE agreement. So what it does is it eliminates this quote unquote risk to the startups and also to the financial system by suddenly having investors call all their loans. So as you can see here, it sits as a special class of equity. Now, because it was created by Y Combinator, where Y Combinator only cares about venture scale, right? They want the next Facebook and Airbnb and everything else, that it was trying to convert on a preferred shared round. So the premise behind a SAFE agreement is that its original purpose was to create a financing where you could defer the valuation conversation to later while clearly signaling to investors that your next round is going to be a preferred share round. In other words, your next round is going to be a venture capital round, period. So we're going for it, and we're going to raise a venture capital round. Made a ton of sense for Y Combinator, but when it started to get pushed out, at least initially in North America and then beyond, people were like, well, hold on a second, like, we don't have a bunch of like unicorns in our city. Like, am I going to ever convert? Like, are they ever going to do a pref round? And so what actually people realized pretty early on is version 1 of safe agreements actually were problematic because they didn't have a timeline and they didn't have like a hard conversion mechanism. And you can see that that's initially listed on this chart. What has happened now over time is there are multiple ways to convert a safe, including a set timeline and including the future financing of any type, not just preferred shares. So what is funny is that after 10 years, basically a safe agreement is a convertible note agreement. And the only distinction is that one sits as a true loan books that can be redeemable and the other one can't. That's the distinction between the two. So again, if you're an SF, everybody takes it seriously that you're going to raise a VC round. If you're in, I don't know, like Des Moines, Iowa, or Berlin or someplace like that, they're not thinking necessarily, that you're going to go all the way, right? You have to think about why it is that you're doing a safe. To your point earlier, Sarah, about safe agreements and innovative structure and the Global South, on a personal note, I don't think a safe agreement is, I personally think a safe agreement actually probably extends the inequity because it's a complicated process to understand. It doesn't sit like on balance sheet, you're creating a whole new class. Like it doesn't sit as a loan, but it doesn't really sit as equity. It's kind of this special class and it's a contingent loan. And, like it's, it pushes the boundaries. And so, but the reason that you probably are hearing about it is important for everybody to remember that the people who are using these pieces of paper are human beings. And human beings, hopes and fears and dreams, and they have patterns and they have likes and dislikes. And right now, a safe agreement is in vogue. It is popular. And so you'll find a lot of entrepreneurs and investors saying, of course, we're going to do a safe. But it's not necessarily the right piece of paperwork. So I think it's really key to educate the entrepreneurs, but also the investors, like what is the right tool to use at the right time? And then preferred shares, I think fairly straightforward, at least from my perspective, but to make a long story short, a preferred share is where you're giving, again, that maximum preferential treatment. And it includes things like a discount on future rounds. Typically, you're getting preferred treatment on the future sale of the business, on future financings. And those terms, if you wanted to look them up, would be terms like liquidation rights, drag along clause, board seats, like these would be some of the common ones that you would find. There's also right of first refusal, or the ROFR agreement would be another example of things that are typically automatically included in a preferred share agreement. And so for me, a preferred share agreement for most startups occurs at that A round when they have that first venture capital firm come in. Or it might occur in like just a regular small to growing business where they need to provide some extra incentive to get people to invest or invest more. So I'm going to pause there because that gives you kind of like a base overview of what some of these are, and it might open up some questions or conversation either about the individual pieces of paperwork or about their uses and when and kind of ideal times, etc.
Could you just repeat that last point about more established companies and preferred?
Yeah, so typically when you have so let's assume they're not like a venture scale tech company, right? So they're just a great, kind of growing business. and they're looking at ways to bring investors into the company. If the company is really thriving, and revenue is strong and margin is strong and the business, like all the right metrics are there, you can have investors come in on more common shares, like you can extend the common share pool. But sometimes as businesses are evolving and they're seeking that growth, they might see a little bit of an up and down in the numbers, or they might have, a few skeletons in the closet from the past. And so investors at that point in time might be looking for some extra like special treatment to kind of give them that, I sense a bit more risk, so I'm looking for a bit more reward. So that's where a preferred share deal would come in. So it's really about assessing the risk reward profile of the company. That has to be done both by the entrepreneur and by the investor to kind of determine if they need to go off the, kind of off the standard common share deal and into pref. If that makes sense.
It does. Thank you so much.
Cool. Thank you. It's a great question. Any other questions?
Hi, yes. I have one question around whether, I know you brought up Canada and you brought up the US. So are these 4 types of paperwork, are they pretty US, like North America centric? Or would you say that these are also used globally?
Oh, so great question. Common shares are global. Almost every ecosystem in the world would have the ability for people to purchase common shares in a business. In most jurisdictions, you will have a variation of preferred shares, partially because those have been the longest standing methods of investment in a business. Convertible notes would span all of the developed world plus some of the developing world. So you do need to check in jurisdiction by jurisdiction on convertible notes, right? So for example, if you go into the Western Balkans, you can do a convertible loan in Serbia, but you cannot in Bosnia. Or for example, in Vietnam, you cannot do a convertible loan in Vietnam, as just a couple of working examples. So SAFE agreements being the newest form at only 10 years old, it really purely is the domain of the developed world, like Western Europe, North America, Singapore, Hong Kong, that's about it. There's not many other jurisdictions where you can freely do a SAFE agreement. So if you are working with an entrepreneur in one of the other countries where no SAFE agreement exists, and they're working with cross-border investors, and the cross-border investors insist on a SAFE, you're automatically moving the legal headquarters of that company to one of probably the most obvious regional jurisdictions, right? So if the country is developing, but in and around Europe, you're probably looking at a UK or Belgian corp. If you're in Southeast Asia, you're going to set up a Singapore corp. And if you're anywhere else in the world, it's going to be a Delaware corp. That's the only way you can pull off a SAFE. So it's a great question.
Thank you.
Yeah, for sure. Anytime. Excuse me. I was trying to find my mute button and it disappeared on me. Sorry. Cool. So the important part from my perspective is, as we are working with companies, and also as we're trying to do deals, because sometimes we're on either side of the table, either active or representing, the important part is that as it relates to convertible notes and SAFE agreements, one can consider that any individual term or clause is fully interchangeable between the two, aside from the legal form, which is a loan or a SAFE. So just noting that. And then the second piece is any piece of preferred treatment that exists in a pref share can absolutely be applied in a common share agreement. Yeah, without question, actually. And so that goes back to my earlier comment, which is, it's one thing to know the overall form of the agreement, but it is really important to note that you need to really read the terms and conditions both based on what the entrepreneur might present and or what the investor presents. So one example I will give you is, if you see a common share agreement where an investor has put in a 2x liquidation pref, and what that means is when the company sells, I get double my calculated return, right? So if I'm supposed to get $1 million back on my 100K investment, with a 2x liquidation pref, I'm getting 2 million, period. And I get it first, right? Before anybody else takes their money out. So that is one of those what I will call very investor friendly terms. Some might call it punitive, depending on how you view the world. And so it's a great example of what can be moved around from document to document. So I just wanted to make sure that we did highlight that as we went through. Cool. So just to cover off a few things, just to make sure I've covered everything off. Again, common share is the simplest form. It's easily understood. It's widely used. It's truly global. And the important part is that there can be some other people who will get their money out first, like bondholders, preferred shareholders, if you have them, secured debt holders, right? So common shares is definitely the most democratic in that perspective, and they will take a backseat to some other forms of investment capital that the organization has taken in. But just covering that off, and hopefully that makes sense. So for convertible note, the important part here is, especially in the developing South, Sarah, to your question, what a lot of entrepreneurs don't know, especially if they haven't received like a sufficient amount of financial literacy training, is they don't realize the implication that a convertible loan will have on their books and their balance sheet. Because sometimes a convertible loan will break their debt to equity ratio if they have a loan with a bank or some other institution. Because in their mind, they're thinking it's equity, but legally it sits as debt on the books, and therefore it impacts either the current loans that you have and or your ability to take loans in the future according to the term of the convertible note. And so that's a really, really important part in this. And then just noting as well that it is almost always triggered by the next financing that the company goes through. So typically, companies will take a convertible loan will have a term of between 18 months and 3 years. The universal truth average is 2. So typically it's a 2-year term. And the reason people are doing this is because they can't quite agree on the valuation, and the company's just moving fast enough that you just know you're going to do a round in the next 12 to 24 months, and that'll trigger the conversion into equity. So that's the important part that comes in. Convertible notes often are considered to be quite angel investor friendly, as well as can be founder friendly if you don't agree on the valuation, if you want to go right to a share sale. Great. Poke me if you have any questions. So for a safe agreement, we talked a little bit about this. I did note here, by the way, that there is there's a Canadian standardized version, which Osler law firm set up. I can say the exact same thing about every major, developed country jurisdiction. They all have their own templates or standardized versions that have been developed. So it's pretty interchangeable, which is good. But again, if you're going to do a safe agreement in a lot of countries right now, you can't. And so the question in those countries is, do you need to do it, or are you going to push the legal entity into another jurisdiction? Cool. Preferred shares, again, typically the domain of venture capital funds in those growth stage. So I think all fairly straightforward. So maybe what I'll do is I'll pause here and I'll just see if there's any questions about any of these specific types, if there's anything you want to dig into. And then the next step for us is to dig into some of the newer things. Awesome. I'm clearly telling you guys too many things because I'm not triggering any questions. So I'll keep going and we'll see how we do here. So yeah, maybe just a couple of preferences just before I trigger things off. It is important to note as well that if you are working with ventures and just I think about it like Natalia, you were talking about just coming back from Palestine. Like if you're working with organizations in Palestine and there's a group of investors that typically work in Palestine, they're going to have a set of individual preferences. Whereas investors in New York, Silicon Valley, Vancouver, Singapore, each group, like each community will have its own generic set of preferences. And then also there will be individual at the person level, sometimes at the angel group level as well. Like I know some angel groups who really don't like doing safes at all. I know other angel groups that love safes. So there's definitely a lot of preferences that you want to keep in mind. So if you're supporting an entrepreneur that's working through this, the important part is to get them and or in the work that you do, find out what the investors like to do. You need to get agreement, because if some people like commons and other people like preferred shares, somebody might put their foot down and say, I won't move. And then you suddenly don't have a round, right? Because most entrepreneurs, when they're raising, they're going to raise from typically 6 to 20 investors, the makeup of the round. And so you have to get to consensus. And that's really, really important as we go through this. Cool.
Thank you for that.
Yeah, of course. Absolutely. Awesome. So I did highlight this a little bit earlier, the trends by types of rounds. So it has been the trends that I've seen over time. And so I just wanted to highlight this because it is just the reality that each one of these is just a legal document. There's terms and conditions within. Objectively, there's no reason why there should be a trend. You should just be able to pull a piece of paper off the shelf, insert the terms and conditions and go. But human beings being human beings, they have their preferences and they kind of like to stick to one thing for a little while. And so at the moment in the developed world, and in particular North America, safes are the hottest. For better or worse, in each case, in every stage. So, but that's currently what's happening. So if you guys were all in a pinch and you need to do a deal today, you would pull out a safe agreement, work from that, because you just know the majority of investors would know it. It'd be easy to talk to them about it, go from there. I personally don't think they're to the maximum benefit of the entrepreneur. So again, because of the increasing level of sophistication that is required to understand it for the entrepreneur, and sometimes the requirement that it might place on the entrepreneur to do things in future financings that they may not necessarily want to do, like preferred share round, right? And it's probably worth noting that at the end of the day, when you're in a round, you can negotiate every term and condition. The same is also true between rounds. Like if a company raises a safe and 2 years from now, everybody looks at the company and says it's clearly not going to do a VC round in the future, you can always open things up, renegotiate, and move forward. But that always takes time and money and energy, and sometimes bruised egos and other things. And so the closer you can get it to right up front, the far better it is for everybody. So cool. Awesome. This is pretty straightforward. So I'm assuming no questions. Cool. Let's talk about newer approaches. This is getting into some of the fun stuff that we talked about. So you're going to look at this and say, but Keith, loans have actually been the oldest ever, like in the history of humanity. And that is true, but loans have started to come back into vogue for businesses where, they profile as good growth businesses, but they just are not venture scale. Like there's just not a need for equity. where you might be willing to take on greater risk, but for greater reward. And so what's great about loans is that they are coming back into vogue. One thing I will highlight is, given the work that we've been doing around impact investing, one of the drivers behind the increase in loans actually has been the growth of gender diverse founders in businesses in North America. What's interesting is that a lot of the gender diverse founders are saying, hey, like, I want people to invest, but I'm not going to give them anything. Like, I'm not going to give them a piece of the company. And what that's really doing is it's a method of giving agency and to the founders to say, this is my business and I can choose how I want to scale it. So one example, if you all want to check it out, there's a company called Bloom, which I just put in the chat, and it's a company that is focused on women's health products at the retail level. They actually started off in the menstrual care space and then have expanded into a broader line. Just started with their own e-com. They just started rolling out across Sephora. They're doing incredibly well. And so they went through a process of thinking about raising around, not only as female founders, but also as people of color. And so, you know, they had a brutally hard time trying to raise around because the system was not built for them. And after a while, they're like, you know what, there's a different way to do this. So they actually catalyzed the scaling of their company through loans. And they did it through a couple of different sources. And if you guys know Clearco, Clearco gave them their biggest loan, which was about a year ago. And they really started to accelerate their growth. They just did a round of capital, but they did it at a time where they can actually drive the bus on the terms. So loans, yet what's old is new again, but I think it's really worth embracing this. And so Sarah, to your earlier point, it's also a place where I think in the global south, there's new ways to start to think about how we do this. And this starts to slide us into revenue-backed financing. And so revenue-backed financing, I mean, technically has been around for a while, but it started to like gain a lot of momentum in 2015, 2016. And now there's major players in the revenue-backed financing space. And there's a lot of individual investors and everybody in between who are getting into it. But to the earlier conversation with revenue-backed financing, the beautiful part about revenue-backed financing is typically there's no term. So what it allows is for greater flexibility on when the loan is being repaid or not. It gives greater flexibility for businesses that either are thinking about expanding into new markets, expanding new product lines, or pivoting, right? And looking for maybe to kind of fix some of the challenges that they have in the business as they're growing. And so the term or lack of term is usually the big hook behind revenue-backed financing. Yeah, Pomona Impact, absolutely, Sarah. I know it well, and great team, by the way. And so the important part here is that there's actually a couple of ways that you can do revenue-backed financing. So revenue-backed financing will sit as a loan again on the books, and the important part is you can shape it according to what makes sense for the business. So I'll give a couple of example ways in the structure that you can think about how you do this. So on the first example, you're looking at a percentage of gross revenue. So typically when you see a gross revenue based revenue-backed financing, it's 3 to 5% of gross revenue is the typical range. And that is paid out typically on an annual basis, and it is paid out in cash. And so in that context, the levers that can be pulled in the transaction is one, it can be based on gross revenue. The other one though is obviously it can be based on profit. And you can define that in a couple of different ways, but for simplicity's sake, I'll say net profit, and then the percentage is different. So maybe instead of 3 to 5% of gross revenue, maybe it's 5 to 20% of net profit. So where that actually makes a lot of sense, for example, is if a company has a lot of certainty on where the revenue is coming from, then doing a gross revenue-based revenue-backed financing can make a lot of sense, especially if you're cash flow positive and you have some history of being profitable. Doing a profit-based revenue-backed financing is great, where you have much less certainty on profitability, right? Obvious. So revenue-backed financing is one of those great tools that especially an established business can use when you're pivoting. When an established business says, hey, we've I don't know, hit a ceiling on growth, or we were doing really well, but we've stumbled and we can see the path, like either a change in customer base or sales and marketing channels or production or product line, so you can see the path, but you can see an interrupted kind of flow of profitability during the time. So revenue-backed financing is great because if you hit profit, then that actually gives you a bit of breathing room, that if you're still generating revenue but not margin, then you don't have to pay back that year. The sweetener for the investor is the multiple. So typically a revenue-backed financing is never based on a percentage, it's based on a multiple of the loan amount. And so you'll notice here that I've put in the range, which is 1.5 to 2.5x the loan amount. So if I get $1 million, then I'm going to pay back 2. But it could take me 3 years if my company's doing awesome, or it could take me 12, right? So the point being, there's that flexibility. And so typically when the entrepreneurs and the investors are assessing risk, then that multiple will go up and down accordingly. My personal experience has been, if any investor thinks that to cover the risk, they need to take greater than 3x, they just walk away from the deal. They're just like, yeah, this is just too much risk in this deal. I can't at 3x return, anything more than that, it just doesn't feel like it's worth my time because there's too much risk in the deal. So I have seen a few 3x deals, not many. Most of them are 2x. But I've definitely seen 1.5 to 2.5. So just to give you a bit of context on what that is. In the paperwork, and Natalia, maybe this is starting to speak to your particular background on this, and the questions that you might have. But the important part is that it's in the terms of the paperwork, how it gets paid and how it's validated. So in other words, how do you confirm revenue? How do you confirm margin? When do you pay? Are you paying quarterly, monthly? Are you paying annually? So what is that process that unfolds? And I think that's actually probably the most important part about the revenue-backed financing is to agree on what that is going to look like, because people are going to want to have confidence on both sides of the fence. Yeah, if that makes sense. So Natalia, knowing that you had some earlier questions, I'm not sure if I covered it all off, but I'd love to hear what questions you have about revenue-backed financing.
Thank you. No, that was really helpful. If you could you give me some players in the field? I think you mentioned you might be able to do that.
Yeah. So probably the biggest player in the field right now is ClearCo. And if anybody here doesn't know what ClearCo is a firm that both provides revenue-backed financing. Well, actually 3 things: revenue-backed financing, loans, and equity to e-com companies. They've raised, I don't know, I think it's about 165 million. I think I may have temporarily lost you guys.
You did, but you're back now.
Yep.
Cool. What I just said was the most important thing I've said for an hour, and now it's gone forever. I can't remember what I said. I'm just kidding. Just kidding. And so, yeah, yeah, exactly. Yeah, so Natalia, Clearco is one of them. I put it into chat. One other one that I think is actually quite interesting. Sorry, auto spell check there. Let me get that back for you. It's not Time Capital, it's Tamaya Capital. Tamaya Capital does revenue-backed financing exclusively for enterprise SaaS companies. So that's kind of where it's at. Okay, I may have to, cool, I'm just on a call, I'll jump out. Okay. Hey guys, apparently the room that I'm in is now booked. So I'm gonna see if you guys wanna spool up some questions and talk amongst yourself for 90 seconds, just so that I can jump to another room. So I'm gonna just shut off. I'm just gonna shut off my video and my audio, and then I'll be right back. Many apologies.
Thanks, Keith. And Sarah, I know that Natalia had to drop, but if you have any questions or things that you want Keith to focus in on, feel free to jump in or put them in the chat as well.
Yeah, will do.
All right, can you guys hear me now? We're back.
Yep.
Okay,
Perfect.
cool, awesome. Thank you very much for waiting. Awesome. So yeah, where was I? Cool. So Tamaya Capital, as I was saying, enterprise software as a service, that's exclusively what they do. So you're seeing a trend now, Clearco, Tamaya Capital, and the other ones that I know, typically speaking, they are sector specific or business model specific, right? So e-com, SaaS, some, like I've seen a couple that are specific to food. If you guys want to check out one that's really interesting from my perspective anyways, there is an organization out of Victoria, BC, Canada, which is called Scale Collaborative. And they have a fund. It exclusively invests in nonprofits, charities, and co-ops. And so they use revenue-backed financing for that particular model, as well as loans. And so it's a great way for them to provide that. So that would be like just another interesting case study. So just a couple of examples for you, Natalia. And I think I lost Natalia actually. Sorry, I just realized Natalia's gone missing.
Yeah, she had to drop to go to another call, but
okay.
I'm taking notes for her.
Okay, amazing. Thank you so much. So the other one that I did want to mention is redeemable shares. And so redeemable shares is an interesting one because sometimes when investors and entrepreneurs come together to try and scale a business, there's a desire to kind of acknowledge both an approach that is equitable, acknowledges the value of the investment when it occurs, also values the ability for the entrepreneur to retain ownership, and logistically helps to deal with this kind of challenge of like having so many loans on the books. And so with redeemable shares, the premise is that you're actually selling a second class or an extra class of shares. And in selling an extra class of shares, those shares are redeemable through a percentage of revenue. So instead of a straight revenue-backed financing, what you do is you give a second class of shares. So I'll call them, for argument's sake, Class B common shares. And so with these Class B common shares, the day that I invest, I get equity in your business. And then over time, you buy back those shares through a percentage of either revenue or profit. What's great about this is that, imagine the following. If I invest in, say, for example, Sarah, you have an amazing startup and you say, hey, listen, Keith, if you invest, it could be catalytic for my business, but I want to honor that, but I also want to be able to like ultimately have control over my equity. Then if I invest today and that creates a catalytic event that says in a year from now, you sell the business for a great return, then because I still own a piece of the company, I also benefit in that upside. But then in the subsequent years, if you continue to own the business, year 1, 2, 3, and so on, the benefit for you is you say, there was a catalytic event where Keith invested, but now as time goes by, I, as the owner and my team, we actually have had the greater say in the successful outcome of this business. That's why I'm buying the equity back. And so the benefit there is it really kind of acknowledges this, like the catalytic impact that capital can have at a moment in time, but it also really honors this like ongoing accretive contribution that the team has, and the ownership, like the original ownership, and the founders have. So personally, I really like that component of redeemable shares. The other thing is that you can offer it in one of two ways. So one is that you can say that for these redeemable shares, you will get, a set of shares today, and over time, I will buy all of them back. But sometimes you could be in a room, like say Sarah and I are in a room, and we're looking at each other saying, hey, this is an amazing opportunity. And Sarah's like, I'm really passionate about my business. And we're talking about where this thing is going. We may look at each other and say, you know what? This thing is going to be a really great business, but it might actually go super big. Like it might be a world-changing idea. We don't know. So what you can also do is create a redeemable share structure that says, Keith will buy 100 shares in my business, and over time, I will buy back 70, but Keith can keep 30. So the premise is that you leave this little hook there that if there's a desire for kind of like upside, and if you want to also basically give that fair exchange of value to the investor and say, I want you to always have a little piece of upside, right? Like you could go 100% buyback, you could go 90, 80, 70. So the benefit is you can actually structure it in a few different ways. And so for me, redeemable shares is a really interesting model. The organization that first started like what I saw anyway, started mainstreaming redeemable shares, which is an organization that Sarah knows well, which is Fledge out of Seattle. Fledge is also known as the Conscious Company Accelerator. They run accelerator programs. They also have a fund. They do a lot of work in sub-Saharan Africa with a dabbling in LATAM in particular. And so they were really one of the first people to kind of like default offer redeemable shares as kind of their de facto model. I would say to you that in Spring's global experience, we probably see, I don't know, maybe 6 or 10 deals a year. So they haven't like taken off. They haven't been mainstreaming. say like a safe agreement has done, or previously convertible notes. And typically the reason for that, to be perfectly honest, is because most investors today are traditional investors. And frankly, they kind of look and talk like me. And so what that means is most investors are unwilling to give up the potential upside opportunity of venture scale. So most investors that I hear that don't like redeemable shares, they say that because they're like, well, hey, listen, if I'm participating in risk, I want all the upside.
Oh, Keith, your audio dropped for some reason. We can't hear you. No, still nothing. Yep, take your time. Hmm.
Keith, you may have to click the up arrow next to the mute button on your Zoom. It might have switched your microphone input maybe, and just make sure that
yeah.
it has a tick next to the one that you're wanting to be using.
Hey, you guys hear me now?
Yep.
Okay, so the trick I find sometimes is when you start Zoom on machine audio and then you add the mic after the fact, sometimes it kicks you back out. So anyways, apologies, I had to turn Bluetooth back on and off. I appreciate you guys going through that. So I gave you guys a mouthful on revenue-backed financing. And so again, it is this really cool idea that says the ownership percentage is fully in the control of the entrepreneur. They can decide how much they buy back. So they can, at the end of the financing, they can still own 100% of the business. You're kind of honoring this idea of a catalytic event that is the financing. The other side note is that it does not sit as a straight loan. It sits off the debt side of the balance sheet a little bit. And so what that means is it still provides a little bit of flexibility for the entrepreneur to be able to take more traditional loans if it makes sense at the same time. So I'm going to pause there and just see if that triggers any questions or comments from everybody.
You kind of cut out when you said that some investors aren't fond of this model because I think you were saying the fact that they would be taking on this amount of risk.
Yeah, so thank you for circling back on that. So the premise being that traditional investors say, I'm investing in your business, that's risk. Therefore, I want to be able to participate in all the upside. So don't cap me on the multiple of the redeemable component. That's really ultimately what they're trying to say there, if that makes sense.
Yes.
Cool, that's great. So so thanks for asking that question. So as a follow-up to this, by the way, if anybody wants to see what a template redeemable share agreement would look like, let me know. I'd be more than happy to provide like a working sample. The sample that I have would be in the Canadian context, but the cool thing, Sarah, given where you are, is that the example, let me figure this out. I clicked on the wrong thing, and so now I'm gonna come back. There we go. Okay, so okay, Sarah, great. I'll also give you my LinkedIn profile, but I will send you a note coming out of here with that template. The benefit with the template, Sarah, is that it is set up as a Delaware, what we call Delaware clone. So when you read the document, it's literally going to look exactly what you would expect from a Delaware corp. with the exception of when you get down to litigation, it says the province of BC. Like it literally looks the same. Make sense? Okay, awesome. Any other questions on redeemable shares? Cool. So one thing I am going to touch on, some things to consider. So a couple of considerations that I have and know. So for the investor and the founder or the investor, you can see that the first two are exactly the same. What is fair and where is this company going, right? If you're going venture scale, you really can look at all options. Especially on the equity side, right? You can look at things like safe agreements and preferred shares, and you can be confident that it's going to get there. But if it's a small to growing business, you're probably not going to look at safe agreements at all. In addition to that, with pref shares, you're only going to use pref shares if you need to offer some kind of preferential treatment to the investors, given whatever unevenness or whatever challenges are happening in the business. But it tends again to really change the power dynamic when you have pref shares, because pref shares will stand above all commons, which means the preferred shareholder stands fully above all the founders and all the existing owners. So it's a fundamental shift in power. And so just, kind of worth noting from that perspective. And then investors are always thinking about risk and reward. They typically will want to socialize the deal and find out what other investors are thinking and feeling about it. And then the other key piece, when we start to talk about these things like owning 100% equity versus a loan versus revenue-backed financing, is how am I thinking about building my, kind of private portfolio? How much risk overall am I willing to bear? How do I want to spread this around? And for the founders, there is this conversation about, what does it mean to bring an investor on board that is strategic? And one example that I'll give everybody, because I mentioned the Indigenous community in Canada earlier, is in Canada, there's an organization which is called Raven Indigenous Capital Partners. It's the first Indigenous owned and led venture capital fund in Canada, I think in North America. And so when they're considered to be quite a strategic investor for Indigenous entrepreneurs. And so what's interesting is they themselves actually create very interesting structures. And one thing that I'll share actually as a part of this, and if Sarah is listening to the recording, if Natalia is listening to the recording, or Sarah, if you share it with her, there is a new movement, which Raven actually is one of the pioneers in this movement, which is called flexible VC. And one of the amazing things about flexible VC, again, being driven often by traditionally underrepresented funders who are now leading venture capital funds, is what they are doing is they're getting involved in offering some of these more dynamic deals like revenue-backed financing, like redeemable share structures, as a way of creating a balance of power and a new type of relationship between a venture capital fund and an investor. So Raven, and I'll just put this in a chat, just so you guys can check it out, because they're really, really amazing. But Raven, they actually have done a couple of revenue-backed financings. They've also done redeemable shares. So they're very willing to change the nature of the game in order to make it work. And so just to give everybody a bit of a sense, like when you have strategic investors on board, sometimes you can create more flexibility in how you build any one of these alternatives. So I'm going to pause there and see if there's any questions on that. Amazing. You guys are awesome, and making my life easy at the same time. So this is great. Thank you very much for that.
I had a general question, but I don't know if you're going to get to it. And it's more like on asking your personal opinion around what funding models you consider to be the most equitable, or is there a new one that you foresee coming out, or just like looking into, I don't know, I've always been into the discussion around patient capital, but it's really hard to convince a lot of investors, especially traditional investors, about using patient capital, especially in the global South or with companies that are up and coming, and not going for the sort of Silicon Valley scale and grow as fast as you possibly can model. I don't know, that's sort of just a general question that I had that could be for closer to the end of the presentation.
No, it's good. I mean, to be honest, we're actually at the end of the presentation and our timing is pretty good because I think we're supposed to wrap in 6 minutes. Sarah, to your question, I think what we all have to remember is that at the end of the day, investors are not investing for charity. Like in the world that we're talking about here, investment, there is some expectation, at least some expectation of a return on investment. And so to your point about traditional investors, it is important to note that investors are human beings, right? Like, you know, Sarah, like you work at JP Morgan Chase. I am an individual angel investor, but Sarah is Sarah and Keith is Keith. And so we all have like hopes and fears and dreams, and we have habits and we have routines and we have patterns of behavior. And so typically traditional investors will go automatically to a max financial return mindset. So when they're, so your topic, Sarah, about patient capital, you are correct. Only the smaller minority of investors will say, I'm willing to change my pattern of behavior in order to consider that, because it is important to note, like literally for hundreds of years, there's two ways to do this. One was invest for maximum financial return or donate. And so we're asking people in a very short period of time, relatively speaking, as far as humanity is concerned and evolution, we're asking people to move in a very short period of time away from a binary invest for max financial returns or charity to a, actually, there's a lot of ways to do this. And so sometimes patient capital is something that people don't get because they've never done it before. So one thing that I would encourage for everybody is if you're thinking about looking at an innovative structure like a revenue-backed financing or a redeemable share or some other form of patient capital, my encouragement to you is first things first, get 3 to 4 known examples. Because then when you're talking to both entrepreneurs and investors and you say, hey, I think this could be a great revenue-backed financing deal, and they're like, what is that? Like, you know, and you're like, let me walk you through a couple scenarios. Let me show you this company. It's called, oh my goodness. One that I think is a really killer example of the redeemable share structure. If you guys want to check it out, called Cheekbone Beauty. Cheekbone Beauty, Jen Harper, Indigenous founder from a small town in Ontario, Canada. She created an Indigenous beauty brand. Phenomenal high growth company, also has gotten into Sephora. And she did a redeemable share structure because that's part of what she thought was the right thing to do for her and her business. The benefit for all of us is now that's a working example that we can point people at, right? So one thing I would say, Sarah, is sometimes it's less about people's willingness to do it or not do it. It's more about human nature's willingness to try something they've never tried before and trying to answer the question, how do I? And having case studies for them to show them how it gets done. Point number one. Point number two is having a law firm that has experience doing that kind of paperwork. You put those two pieces in place and you're kind of like halfway to the goal. So I just want to make sure that we like, that's such a crucial component here. We're not talking about ATMs, right? Investors are human beings and we have to honor that they themselves can be as flexible or rigid as any other human being, and they can embrace or resist change as much as any other human being. And we need to understand that. But I think the distinction for me personally, and probably this is a closing comment, is we're now in a place where there is absolutely no reason whatsoever that any entrepreneur should feel contained to the traditional structures of like common shares, pref, convertible note, and safe. There's no reason at all. They may end up becoming the best option for a variety of reasons. But now when we have things like, you know, the newer loans, revenue-backed financing, redeemable shares, those are ways that we can really start to trigger more equitable forms of capital, especially when we're talking about a diverse range of businesses with a diverse range of owners who are seeking a diverse range of outcomes. And so I think that that's probably the final comment. And then I'm going to stop doing my screen share. And then, Sarah, I do want to highlight that you asked a question earlier about crypto. I'll give you a fun fact. I think it was like in Serbia 2 years ago. Startups in Serbia raised over $60 million through crypto. And so, and part of the reason was at the time, the regulatory environment didn't allow them to do advanced things like safe agreements. So they were just like, well, I'm just going around the system. I mean, my comment is that it's still wild, wild west in terms of like, how do you protect the company? How do you protect the shareholders? Like, so for some people who are a little bit more courageous and creative and like risk taking, cool. Like I think it's something to explore, but there's not like a monstrous track record of like companies that have raised, what have been some of the outcomes and so forth. So that's getting into just a bit of a brave new world. Yeah. So, and something I know, unfortunately, very little about in the context specifically of early stage private co-financing. Yeah. It's a good question. So
Awesome. Well, we are at time. I want to just be cognizant of everyone's time and energy and everything. So Keith, just thank you so much for this presentation. It really flew by. I thought we still had like another half hour. So thank you so much for that. And thank you, Sarah, for joining and calling.
Yeah.
We'll share a recap email with the recording because I know a lot of people signed up for this specific class. So there's a lot of interest around it for sure. And yeah, I hope that everyone just enjoyed the call today.